Welcome to the session on company accounts part 2. In this, we are going to look at redemption of preference shares and issue of debentures. Okay, so the first part is going to be redemption of preference shares, and which will be followed by questions on issue of debentures. Right. So, with respect to redemption of preference shares, Section 80 of the Companies Act contains provisions with respect to the conditions that have to be satisfied when a company issues preference shares. First of all, Section 80 says that a company cannot issue preference shares that are not redeemable, which means irredeemable preference shares cannot be issued. Second thing that Section 80 says is that when a company issues redeemable preference shares, it cannot be redeemed after 20 years from the date on which these preference shares have been issued. Okay, so which means the maximum term for which a company can hold preference shares before they are redeemed is 20 years. So that is one important thing. Secondly, Section 80 says that redemption can be done out of profits or it can be out of proceeds of fresh issue. Okay, so when profits means divisible profits, so redemption can be out of free reserves or divisible profits. Examples of such divisible profits are general reserve, profit and loss account, the surplus, the other revenue reserves, and dividend equalization account. So these are some examples of free reserves which can be used in order to redeem preference shares. The other option available to a company which does not have sufficient free reserves is to go for a fresh issue of shares. It can be either issue of equity shares or preference shares, and it can be issue at par premium or discount. Right. And another thing is that very important thing that we have to keep in mind is that when a company wants to redeem its preference shares and it wants to mobilize funds, it cannot make an issue of debentures, or it cannot take a loan from a bank. Right. Then secondly, now what happens, what is a company required to do when it redeems its after it redeems its debentures? Section 80 says that when the redemption is out of divisible profits, okay, when the redemption is out of divisible profits, an amount equal to the nominal value of the preference shares redeemed has to be transferred from free reserves to a reserve called the capital redemption reserve account. This capital redemption reserve account is not a freely distributable reserve. It can be used only for the purpose of issuing fully paid up bonus shares. Okay, that is one. Secondly, Section 80 says that where redemption has happened out of free reserves and partly out of fresh issue of shares, then then Section 80 says an amount which is equal to the difference between the nominal value of preference capital redeemed and the proceeds of the fresh issue should be transferred from free reserves to capital redemption reserve. Understand? So this is what Section 80 says. Now, keeping this background, let's look at the questions. Okay, the first question is, when preference shares are redeemed out of divisible profits, which amount is transferred to capital redemption reserve account? Okay, so as I just told you, Section 80 says that when redemption happens out of divisible profits, an amount equal to the nominal value of the share capital redeemed has to be transferred from free reserves to capital redemption reserve. Okay, so answer is nominal value of preference shares redeemed, and it has to be transferred out of divisible profits. So answer is B. Next, when preference shares are redeemed out of divisible profits, a transfer to capital redemption reserve can be made out of. The moment we read this question, we should know that a transfer to CRR can be made only out of free reserves. Now let's see if the reserves that are mentioned in these options are free reserves or not. Okay, Securities premium account is not a free reserve. Capital reserve arising for feature of shares is not a free reserve. Dividend equalization reserve is a free reserve. An unclaimed dividend amount is not a free reserve. It's in fact a liability. Okay, so answer is C, dividend equalization reserve. Next, which of the following accounts can be transferred to capital redemption reserve account? Again, they are asking us which of the following is a free reserve. General reserve is a free reserve. Forfeited shares account is not a free reserve. Profits prior to incorporation is a capital reserve. Securities premium account is again not a free reserve. So answer is A, general reserve. Next, which of the following accounts cannot be used for the purpose of creation of capital redemption reserve account? P&L account credit balance can be used because it is a free reserve. General reserve can be used because it is a free reserve. Dividend equalization reserve can be used because it's a free reserve. Unclaimed dividends cannot be used. Okay, so answer is D, unclaimed dividends. Next, the capital redemption reserve account may be applied by the company, right? So the moment we read this question, we must make up the answer in our mind that capital redemption reserve can be used in order to issue fully paid up bonus shares to its shareholders or its members, right? So option A, fully paid bonus shares to creditors, is wrong. Fully paid bonus shares to members is right. Fully paid bonus shares to its employees is wrong. Partly paid bonus shares to its members is not right. So answer is B, fully paid bonus shares to its members. Right? Then we come to question number 6. According to section 78 of the Companies Act, the amount in the share premium account cannot be used for the purpose of option A, issue of fully paid bonus shares. This is not right because section 78 says that share premium account can be used for the purpose of issuing fully paid up bonus shares. Writing off losses of the company. This is not permitted. Share premium account cannot be used to write off losses of the company, though it can be used to write off preliminary expenses and write off expenses or discount on issue of shares or issue of debentures. Another thing we have to keep in mind is that share premium account cannot be used to write off the premium on redemption, right? Next, so answer is B, writing off losses of the company. So the share premium account cannot be used for this purpose. Next, redemption of preference shares constitutes reduction of authorized capital, constitutes reduction of issued capital, constitutes reduction of subscribed share capital, does not constitute reduction of authorized capital. Redemption of preference shares does not constitute reduction of authorized capital is the answer. Next, issue of new shares under section 80 always constitutes an increase of authorized capital, never constitutes an increase of authorized capital, does not constitute an increase of authorized capital unless the old shares are redeemed within 1 month after the issue of shares, constitutes an increase of authorized capital if the old shares are redeemed within 1 month after the issue of new shares. So these are the 4 options available to us. Okay, so section 80 very specifically says that when shares are redeemed by making a fresh issue of shares for this purpose. So section 80 says that when the company makes a fresh issue of shares exclusively for the purpose of providing for redemption of preference share capital, and if the issue of if the redemption of preference shares happens within 1 month after the issue of new shares, then it does not constitute an increase of authorized share capital. So why is this relevant? Because when a company makes a fresh issue of shares, it is likely that it breaches the maximum capital that it can raise, and the authorized share capital we also know is otherwise called the registered capital, because a company has to pay its fees based on the capital with which it is authorized or capital with which it is registered. So if the redemption of preference shares happens within 1 month from the date on which the fresh issue of shares for this purpose is made, then it does not constitute an increase in authorized share capital. So answer is C. Which of the following statements is false? Okay, a company can redeem its preference shares is a true statement. Preference shareholders are creditors of a company. It is a false statement. The part of authorized share capital which can be called up only in the event of liquidation of a company is called reserve capital. That is true. Capital redemption reserve can be utilized for issuing fully paid bonus shares is true. So the false statement is preference shareholders are creditors of a company. They are owners of the company. Okay. Next. Which of the following statements is false? Capital redemption reserve cannot be used for writing off miscellaneous expenses and losses. It is true. CRR can be used only for the purpose of issuing fully paid up bonus shares to its members. Capital profit realized in cash can be used for the payment of dividend. Is true. Then reserve created by revaluation of fixed assets are not permitted to be capitalized is true. Dividend is payable on the calls paid in advance by shareholders is false. Okay, so the first three statements are true, and dividend, when shareholders pay calls in advance, they are not entitled to get dividend on the calls that they have paid in advance. Okay, so answer is D. Next, X Limited decides to redeem 650 15% redeemable preference shares of rupees 100 each at a premium of 10%. It has general reserve of 70,000 rupees and securities premium of 4,000 rupees. If it is decided to issue 2,500 equity shares of rupees 10 each at par for the purpose of redemption of preference shares, the amount required to be transferred to capital redemption reserve is. Okay, so we'll apply provisions of section 80 in this case. Section 80 says that the amount to be transferred to CRR is equal to the difference between the nominal value of preference capital redeemed minus proceeds of fresh issue. Okay, so here what is the nominal value of preference capital redeemed? It is 650 into 100 minus proceeds of fresh issue is, okay, here the issue is made at par, so proceeds of fresh issue is 25,000, and so the amount to be transferred to CRR is 40,000 rupees. Okay, so answer is D, 40,000. Next, X Limited decides to redeem 650 15% redeemable preference shares of rupees 100 each at a premium of 10%. It has general reserve of 45,500 rupees and securities premium of 1,000 rupees. If the new equity shares are to be issued at 30% premium, what is the minimum number of equity shares to be issued for the purpose of redemption? Okay, so here they are asking us to find out how many equity shares have to be issued for the purpose of redemption, right? So this company has to redeem preference shares having a nominal value of 65,000 rupees. Okay, and the free reserves available is 45,500 rupees, which means the minimum issue that it has to make should have a face value of 19,500 rupees, and they want to make a new issue at 30% premium. Okay, which means the premium that they will collect if they make an issue of 19,500 is 19,500 into 30%, which is 5,850. Okay, now the company has to redeem 65,000 rupees plus it has to pay a premium of 6,500 rupees at the time of redemption, right? And let's see what is the securities premium balance available? The existing balance is 1000 rupees plus the premium on fresh issue is 5850. So 6850 will be the securities premium available, right? So this securities premium is sufficient to cover the premium on redemption of preference shares. Okay, so this securities premium is sufficient to cover the premium on redemption of preference shares, and hence the number of equity shares to be issued will be 19,500 divided by the nominal value of one equity share, which is 10 rupees. So 1950 equity shares have to be issued for the purpose of redemption. Okay, so answer is A. X Limited decides to redeem 650 15% redeemable preference shares of rupees 100 each at a premium of 10%. It has general reserve of 45,500 and securities premium of 1000. If the new equity shares are to be issued at 25% premium, the minimum number of equity shares of rupees 10 each to be issued for the purpose of redemption is how much? Okay, so this is similar to the previous problem. So here the company has to redeem preference shares having a face value of 65,000. It has free reserves of 45,500, which means the minimum issue that it has to make is 19,500. The company wants to make an issue at 25% premium, which means the premium on fresh issue will be 19,500 into 25% is 4875. Okay, and existing securities premium is 5,875. Right, now the company has to redeem 65,000 at a premium of 10%, so the premium on redemption is 6,500, which means that this premium is not sufficient to cover the premium on redemption, and hence the number of equity shares to be issued will be 65,000 plus 6,500 minus 45,500 minus 1000 divided by the issue price, which is 12.5, which is equal to okay, so this will be 71,500 minus 45,500 minus 1000 divided by 12.5, which will give us 2000 shares. So the company has to issue 2000 shares at an issue price of 12.5 rupees in order to fund the redemption, right? So answer is B, 2000 shares. Next, X Limited decides to redeem 650 15% redeemable preference shares of 100 each at a premium of 10%. It has general reserve of 45,500 and securities premium of 1000. New equity shares are to be issued at 20% discount. The minimum number of equity shares of 10 each to be issued for the purpose of redemption is how much? So here again we have to follow the same approach, because here the shares are being issued at a discount, and hence there is the existing securities premium is only 1000 rupees, and it's obviously not sufficient to cover the premium on redemption, and hence the number of equity shares to be issued will be 65,000 plus 6,500 minus the existing reserves minus 1000 divided by the issue price. The issue price is 8 rupees. Okay, so it is 71,500 minus 46,500 divided by 8, which is 3,125. The company has to issue 3,125 shares at 8 rupees per share. Okay, so answer is C. Next, X Limited decides to redeem 650 15% redeemable preference shares of rupees 100 each at a premium of 10%. It has general reserve of 45,500 and securities premium of 1000. If new equity shares are to be issued at par, the minimum number of equity shares of 10 each to be issued for the purpose of redemption is how much? Okay, so here again, the existing securities premium is not sufficient to cover the premium on redemption, and hence the number of equity shares to be issued will be calculated like this: 65,000 plus 6,500 minus 45,500 minus 1000 divided by 10. So 2,500 shares, right? So answer is D, 2,500. Next, on September 1st, 2006, the company issued 12,000 10% debentures having a face value of rupees 100 each at a discount of 2.5%. On September 10th, the company issued 25,000 equity shares of rupees 100 each. On September 9th, the company redeemed 30,000 6% preference shares of rupees 100 each at a premium of 5% together with 1 month dividend thereon. Bank balance as on 31st August 2000, it should be 2006. 31st August 2006 was 26,60,000. After effecting the above transactions, the bank balance on 30th September 2006 is how much? Okay, so let's open bank account. Okay, so on 31st August 2006, to balance brought down, opening balance is 26,60,000. Okay, next, what is happening on 1st September, the company has issued debentures at a discount of 2.5%. So to debentures 12,000 into 97.5. Okay, that will give us 11,70,000. Okay, next, September 10th, what's happening? September 10th, the company issued 25,000 equity shares of 100 each. So to equity share capital, 25 lakhs. Okay, then what's happening? The company is redeeming 30,000 preference shares at a premium of 5%, which means 105 rupees is being paid for every preference share. So by preference shareholders, 30,000 into 105, which is 31,50,000 by dividend. Preference dividend will be, it's always on the face value, into 100 into 6% into 1 by 12. This will give us 15,000, and the closing balance will be, by balance carried down, it will be 31,65,000. So this is the closing balance of bank as at 30th September 2006. So answer is D. Okay, next, X Limited has redeemed its 12% preference shares of rupees 1 lakh at a premium of 4%. To meet the redemption, it has issued rupees 1 lakh worth of shares of rupees 20 each at a premium of 5%. The balance outstanding to the credit of securities premium account after adjusting premium on redemption of preference shares is how much? Okay, so here the premium on redemption, okay, the premium on redemption is 4% of 1 lakh, which is equal to rupees 4,000 is the premium on redemption. Next, what is happening? The company issued rupees 1 lakh worth of shares at 20 rupees, which means it has issued 5,000 shares at a premium of rupees 1 per share. Okay, so the share premium on issue is 5,000. Now this share premium can be used to write off this premium on redemption, and so the balance left will be 1,000 rupees. So answer is C. Next, balance sheet of X Limited as on 31st March 2006 is as follows. So which means we've been given the balance sheet of X Limited. Okay, the balance sheet tells that it has a equity capital of 10 lakhs, preference capital of 6 lakhs. It has free reserves of 8 lakhs, securities premium is 70,000, and it's got cash of 1 lakh, investments, all that is there. Okay, and then they're telling us that 12% preference shares are redeemable at a premium of 10%. Okay, the company wishes to maintain cash balance at 50,000 rupees. For the purpose of redemption of preference shares, it's proposed to sell the investments for rupees 4 lakh. The company proposes to issue sufficient number of equity shares of rupees 100 each at a premium of 5% to raise required cash resources. What is the cash required to effect the above decision? Okay, so the company has preference shares of 6 lakhs and they have to be redeemed at a premium of 10%, which means the total outflow for the company is 6 lakh 60,000 rupees. Now let's see what is the cash that is available for the company. The company has cash balance of 1 lakh, but they want to maintain a cash balance of 50,000, which means they can use only 50,000. And they want to sell their investments for 4 lakhs. So the cash that the company can get by by the existing resources is 4 lakh 50,000 rupees. It needs 6 lakh 60,000. It has 4 lakh 50,000. So the balance required is 2 lakh 10,000 rupees. Okay, so answer is D, 2 lakh 10,000. Next. Okay, next is the same problem, and they're asking us what is the number of equity shares to be issued. Okay, so we know that the cash required is 2 lakh 10,000 rupees, and they want to issue equity shares at a premium of 10%. Sorry, a premium of 5%, which means the issue price is 105. They require 2 lakh 10,000 rupees, which means they have to issue 2 lakh 10,000 divided by 105, which is 2,000 equity shares have to be issued. So answer is B, 2,000. Next, they're asking us what is going to be the premium on the issue of fresh equity shares. So 2,000 equity shares are going to be issued at a premium of 5 rupees per share, and so the premium on fresh issue is 10,000 rupees. Answer is B. Next, what is the amount to be transferred to capital redemption reserve account? So the amount to be transferred to CRR is a nominal value of preference capital redeemed minus proceeds of fresh issue. Okay, so the nominal value of preference capital redeemed is 6 lakhs, and proceeds of fresh issue for the purpose of section 80, where the issue is made at a premium, is the nominal value, because the premium that you get on issue cannot be used to write off, or it cannot be used for redemption of the face value of the preference shares. Okay, so the nominal value of the new issue made is 2 lakhs, right? And so the amount to be transferred to CRR is 4 lakhs. Next, the balance of securities premium account after adjusting premium on redemption of preference shares is how much? The existing securities premium is 70,000 rupees, and the fresh issue premium on fresh issue of equity shares is 10,000, which means we now have a balance of 80,000 rupees. This can be used to write off the premium on redemption of 60,000, and so the balance left will be 20,000 rupees. So answer is C, 20,000. Okay. Next we come to questions on debentures. Right? Debenture contains provisions regarding repayment of principal only, payment of interest at a fixed rate only, payment of interest at a fluctuating rate only, repayment of principal, and payment of interest at a fixed rate only. Okay, so debenture is basically an instrument that contains an acknowledgement by the company to the debenture holder in order to repay principal and pay interest at a fixed rate. Okay, so answer is D. Interest is paid to the person who produces the interest coupon attached to the debentures in case of bearer debentures. Okay. In case of bearer debentures, okay, there are coupons attached to the debenture, and the one who holds the coupon has to present it, and he gets the interest. Next, from the point of view of mode of redemption, debentures are classified as, okay, so based on security they are classified as secured and unsecured. Based on mode of redemption they are classified as redeemable and irredeemable debentures. Answer is B. From the point of view of security, debentures are classified as secured and unsecured debentures. Secured debentures are debentures that have a charge on the assets of the company, and unsecured debentures do not have any charge on the assets of the company. Next, which of the following statements is false? A company can issue bearer debentures is true. A company can issue convertible debentures is true. A company can issue redeemable debentures is true. A company can issue debentures with voting rights is false. Answer is D. Which of the following statements is true? Debenture holder is owner of the company is false. A debenture holder can get back his money only on liquidation of the company is false. A debenture issued at a discount can be redeemed redeemed at a premium is true. A debenture holder receives interest only in the event of profits is false. Okay, so answer is C. Debentures can be issued at a discount and can be redeemed at a premium. That is a true statement. Next, which of the following statements is false? A company can issue convertible debentures is true. Debentures cannot be secured is false, because secured debentures are debentures that have a charge on the assets of the company. So B is a false statement. A company can issue redeemable debentures is true. Debenture holder has no right to participate in profits over and above their fixed interest is true. Okay, so answer is B. Next, which of the following statements is or are true with respect to debentures? They can be issued for cash, it's true. They can be issued for consideration other than cash, is true. They cannot be issued as collateral security is false. They can be issued as collateral security. Answer is A and B. D is the answer. Okay. In case of issue of debenture of 100 rupees as 100 rupees, but redeemable at 106, rupees 6 is to be debited to which account? Okay, so here there is an issue at par but redemption at a premium. Okay, so when a company redeems at a premium, there is a loss, and that loss has to be recorded upfront at the time of issue itself, and it is to be written off over the life of the debentures. So it will be debited to loss on issue of debentures account. So 6 rupees will be debited to loss on issue of debentures account. Answer is C. Next, securities premium account is a nominal account. Discount on issue of debentures is a nominal account. In the balance sheet of a company, debenture appears under the head long-term borrowings. Okay, under revised schedule 6, all liabilities are classified as non-current and current liabilities. So under non-current liabilities, the first subclassification is long-term borrowings. Debentures will be classified as long-term borrowings, but debentures which are due for redemption within the next 12 months will be classified as short-term borrowings. Okay. Then in the balance sheet of a company, loss on issue of debentures appears under the head other non-current assets. Okay, so this is again a disclosure required under revised schedule 6. Earlier under the old schedule 6, such losses used to be shown under the head miscellaneous expenditure to the extent not written off or adjusted, but now such a head does not appear at all, and so this has to be shown under the head other non-current assets, and but where this loss is to be written off over the next 12 months, it will appear as other current assets. Okay, but there is another alternative disclosure for this loss on issue of debentures is to reduce it from the reserves on the liability side of the balance sheet. Even if the reserves results in a negative figure, there is another possible way of disclosing a loss on issue of debentures. So answer is D. Securities premium account cannot be used to write off discount on issue of shares or debentures is false. Write off premium on redemption of shares or debentures is false. Cannot be used to pay dividends is true. Write off underwriting commission is false. So answer is C, pay dividends. X Limited purchased land and building from Y Limited at a book value of rupees 4 lakhs. Consideration was paid by issue of 12% debentures of rupees 100 each at a discount of 20%. The debentures account is credited with how much? Okay, so here the company is purchasing an asset worth rupees 40 lakhs. Okay, and it is settling this by issue of 12% debentures at a discount of 20%, which means the issue price is 80 rupees. Okay, so what is the number of debentures issued? Number of debentures issued will be the purchase consideration divided by the issue price. Okay, so which means 50,000 debentures of 100 each have been issued, right? Which means the face value of the debentures is 50 lakhs. What is the accounting entry for this? Assets coming into the books. Okay, so asset account debit 40 lakhs, discount on issue 10 lakhs, to 12% debentures 50 lakhs. We must remember that this debentures account should always be credited with the face value of the debentures. So here answer is 50 lakhs. Sorry, it's 4 lakhs, so which means that the answer is 5 lakhs. Okay. Y Limited issued 20,000 8% debentures of rupees 10 each at par, which are redeemable after 5 years at a premium of 20%. What is the amount of loss on redemption of debentures to be written off every year? Okay, so here the premium on redemption is 2 rupees per debenture. So the total loss on 20,000 debentures is 40,000 rupees, right? And this 40,000 rupees has to be written off over 5 years, which means every year the amount to be written off to the P&L is 8,000 rupees. Next. Okay. On 1/4/2011, X Limited issued rupees 1 lakh 15% debentures of rupees 100 each at 94% redeemable at par as follows. Okay, so year beginning 2, 3, 4, 5, which is the same as saying year ending 1, 2, 3, 4. Okay, nominal value of total debentures to be redeemed is 10%, 20%, 30%, and 40%. The amount of discount to be written off each year, assuming that the company closes its accounts on financial year basis, is how much? Okay, so here the debentures are being redeemed in a staggered basis. It's not equal redemption, and so we have to see how much of the loss on issue of debentures is to be written off, and this will be based on the value of the debentures outstanding. Okay, so here first let us determine what is the loss on issue of debentures. So rupees 1 lakh issued at 94%, which means 6% is the discount. So the discount is 6,000 rupees. This 6,000 rupees is to be written off over the next 4 years, okay, based on the value of the debentures outstanding. So at the end of year 1, 100% of the debentures is outstanding. At the end of year 2, 90% is outstanding, because at the beginning of year 2, 10% is redeemed. At the end of year 3, 70% is outstanding. at the end of year 4, 40% is outstanding. Okay, and after this, by the end of year 5, nothing is outstanding. Okay, so now let us see the ratio. The ratio is 10, 9, 7 and 4. The total of this is 30. Okay, and the ratio in which this 6,000 rupees is to be charged off to the P&L will be based on this percentage of debentures outstanding. So it is 10 by 30 of 6,000, 9 by 30 of 6,000, 7 by 30 of 6,000 and 4 by 30 of 6,000, which is equal to 2,000, 1,800, 1,400 and 800. Okay, so this is how it is going to be written off. So answer is C. Next, debenture interest is payable only in case of profits. It's not right. It is a charge against profits, and it is payable even if it is the company is making losses. Accumulates in case of losses or inadequate profits. No, it doesn't. Is payable after the payment of preference dividend but before the payment of equity dividend. In fact, a debenture interest has to be paid before the payment of any dividend. Okay, so answer is D, is payable before the payment of any dividend. Then X Limited issued 515% debentures of rupees 100 each at a discount of 10%, redeemable at a premium of 5% after 4 years. The amount of annual interest on debentures is how much? So the interest is always payable on the nominal value of debentures. The nominal value of debentures is 500 into 100, which is 50,000. On that, 15% is 7,500 rupees, and hence the answer is B, 7,500. Then in the balance sheet of a company, interest accrued but not due on debentures appears under the head. Okay, so interest accrued but not due on debentures was earlier under the old schedule, schedule 6 was shown along with debentures, but now it is to be shown as other current liabilities in the balance sheet. So answer is C. X Limited issued 515% debentures of rupees 100 each on 1st May 2006 at a discount of 10%, redeemable at a premium of 5% after 4 years. Interest was payable half yearly on 30th June and 31st December. The amount of interest debited to P&L account for the year ended 31st March 2007 is how much? Okay, so here the issue of the nominal value of debentures issued is 50,000 rupees. The rate of interest is 15%, but it has been issued only on 1st May 2006, which means for the year ended 31st March 2007, the company is liable to pay interest only for 11 months. So it is 50,000 into 15% for 11 months, which is 6,875 rupees. So answer is D. Loss on issue of debentures is treated as other non-current assets. It's shown loss on issue of debentures can comprise two things. One is discount on issue of debentures, and secondly the premium on redemption of debentures. So this is shown as other non-current assets on the asset side of the balance sheet, and it is written off over the life of the debentures. So answer is D. So with this we come to the end of the review session on company accounts part 2. In case you have any doubts, please feel free to get in touch with me. Thank you.